Hey guys, this is part two of the coronavirus update. So I wanted to start this off by quickly just updating you where we're at in the market, what what has transpired over the last week since I had sent the last video, and I wanted to really get into setting up a portfolio. So we're going to do that this video. So in the last video, we had left off on the 27th. So we were gapping down. I mean, pretty scary stuff. We took out the low from the last time I had sent the video and spent the rest of the week kind of popping and then coming back down a little bit. What is really interesting about this is we set off one of the highest levels in the VIX in a very long time. So the VIX is a volatility indicator. You can make an easy direct correlation that every time the VIX spikes, the market gets absolutely hammered. What it really is doing is gauging how institutions, fund managers, retail investors are hedging their books, hedging their portfolios by buying puts, by going short. It's basically a fear gauge. So the more scared people are, the more they're buying, the more they're getting short, the more they're buying puts, which is betting the market down, the higher the VIX goes. So you can see how extreme 2008, 2009 was. You can see how extreme 2010, 2011 got. And we don't have many instances where we pop over 50. Well, obviously 0809 popped over 50, August 2015, you got February of 2018, again that was very fast, and here we are yet again in March of 2020 popping over that 50 level. What you'll notice is you get that excitement, you get that rush, and then it usually starts fading, right? The longer the VIX stays above these levels, the higher the amount of volatility. So whenever you go on to CNBC and you see a headline and it says the Dow is down 1,000, the Dow is down 3%, 4%, which is huge numbers for an index. Well, you can expect to see more of those headlines the longer the VIX is above, say, 40 or 50. Okay, so we had a bunch of 1,000-point days last week. We had some high 100 days last week. And now we're starting to see some real fear come into the market. I had did a video, I think when I started doing these emails and videos for you guys, I was pointing out that this looked a little overdone. TLT is a bond index. People don't get into bonds when they feel confident about the market. People don't get into bonds when they believe that equities will outperform. They get into bonds for safety. They get into bonds for yield. Well, we haven't had good yields, but people are still rushing into bonds for safety. So from November 18 to August of 2019, really when I started doing the emails and the videos, we were up 32%. From that point on, from the start of these videos to today, we're up another 13%. And you can see how extreme this is getting, right? So the volume is some of the highest volume we've ever seen dating back to 2011. Just to give you an idea of how extreme and how rare of a circumstance this is. We're talking about a full decade of just regular standard volume, and now all of a sudden we're way up. If you look at the 10-year yield, this is hitting all-time low levels. And what's interesting is last week I said, hey, this just hit all-time lows, and we had rushed down 23.76% yesterday on Friday. This is what this does. When yields are so low, it means money is cheap. And when money is cheap, that means things like mortgage rates are going to be less. Your leasing a car is going to be cheaper. All those kind of like tailwinds for the consumer actually make this a positive in a way. The problem, however, and like we were just looking at with TLT, is it creates a bubble, and this is a bubble of epic proportions. The bond market is a multi trillion-dollar market. It's the biggest market there is in the whole entire world. Housing market is nothing compared to this. The equities market is nothing compared to this. And when you create a bubble of this magnitude, you have to understand that even though we have cheap rates, there are kind of repercussions to this. Let's take a quick look at, I'm going to go into, pull this up here. So at the highs of today's session, 30-year bond futures are up 4% and rising. One of those historic days we'll tell our kids about. There have only been 3 others like it in the entire history of bond futures. Stocks rallied the next year 27%, 19%, and 47%. And so we have a ton of fear in the market. And when fear starts dying down, and again, we go back to our fear gauge. When fear starts dying down and everybody starts feeling a little bit better, they're going to be selling off their bonds, and they only really have one other place to put them. Not everybody's going to put their money into private equity, so they're going to have to put it into public equities. So that's a positive. That's one of the positive things. One of the negative things that we're going to have to deal with is this coronavirus. So I think the last time we looked at this, it was under 100K for total confirmed. We are now up over 100,000 cases. We have let's call it 55%, somewhere in that range, recovery rate, and we have a very low death rate to this. One of the things you need to understand when reading any kind of report is the factors that this includes. You have to understand that, one, not everybody who has it is tested. Two, there's so many strains, you have to wonder if the tests are finding the correct case, right? Because I think there's 7 or 8 strains of COVID something, of the coronavirus. So you have to understand that, maybe somebody just had the flu. That kind of goes into this number. I don't know if every single country has the correct testing kits for this yet. Just understand that the headlines are really creating a lot of panic out there. Tons and tons of panic. This is so much different than December of 2018. And if you remember at all December of 2018, how that fast drop happened, if you said, all right, well, what caused these 2 fast drops? There's no chance you could remember what happened. No chance. You have no idea why those drops happened. They can link some things to it, right? They can link some things. I think I've showed you this before, that there's always a reason to be afraid, to be worried, right? But this, as scary as this was not setting off the signals that we are currently setting off now. And those signals are volatility being way up, bond yields just absolutely collapsing. One of the more scary things is oil prices just collapsing. We don't see this often, and it took out the 2018, 2017, and 2016, August of 2016 lows. So the next stop for this could be somewhere down in the 20 range. Here's the thing. Lower gas prices, lower oil prices is normally a net positive for the consumer. The reason why it's a net positive for the consumer, just think about it. Every time you go fill up your tank, it's going to be less. That means more money in your pocket to spend on other things. So that's kind of a positive. The problem with this is going to create an absolute shock to the energy space, and the energy space has already been shocked, right? You look at companies like ExxonMobil just collapsing, absolutely collapsing. Again, a company that makes plenty of money, a company that pays dividends, just just falling like it's a company that's bankrupt. It took out its 2010 and 2008 lows, which is just incredible. It's just incredible. I don't know how much lower this is going to go at this point, but you can get ExxonMobil paying. I think, man, the dividend's got to be up there at this point. XOM dividend. NASDAQ. Let's go here. The dividend of this has to be over 4% now. It's got to be. Dividend yield 7%. So obviously the dividend yield percentage is going to go up as the price of the stock continues to go down. The amount they actually pay out in dollar terms remains the same. So just an incredible dividend yield now on this stock. And you have to wonder, when is it going to be time to buy ExxonMobil at prices you haven't seen since 2004, right? And these are the questions. I'm going to kind of break this up into 2 full videos, because you need to ask yourself, do you care about a trend? Do you care about a stock that's rallying? Or do you care about an undervalued name that pays a huge dividend? Because if you were to start buying ExxonMobil here, and even if it got down to 40, right? If it got back to this pocket of where prices were back in the late 90s, early 2000s, you can capture a huge dividend, and an undervalued company that would be great for a 5 to 10 year hold. Because if you end up getting one of these from 2010 to 2014, and you go up, say 100% in that time frame, or if you get one of these rallies from 2002 over to 2008 when it went up 200%, then that's a great opportunity to get yourself some yield and some appreciation. But here's the problem. The risk of owning energy right now has never been greater. When your oil prices are collapsing like this, and you have Russia and Saudi Arabia kind of duking it out and messing with, the world as far as oil prices go, if I don't know how much further crude oil goes. If it happens like 2009 and like 2016, well, look, 2009 it hit a low, comes roaring back, and then in 2016 it takes out that low in 2009. Let's say we do that again, right? So you're going to have oil at $26, $25 a barrel. It's incredible. That's going to cause so many mergers and acquisitions. It's going to make your head spin. So every single small energy company that has a piece of the pie is likely going to get gobbled up by the companies that are still solvent. So again, an incredible opportunity for the future, but you're going to have to ride out some volatility in the near term. Now, we have so we talked about oil prices, we talked about the bond yields, which are very low, and let's just talk about the economy real quick. So one of the things I want you to understand, and prior to this whole coronavirus thing, everything was kind of going in the right direction, okay? Average hourly earnings, were up and kind of settling back down. If you were to look at unemployment rate, looking great, 3.5%. We actually had some very good economic numbers. I forget if I had bookmarked those. I don't think I did. But we had other great economic numbers that gave you a good feeling. It gave you kind of the, hey, we're going to be all right, because the economy was doing really well. But the lagging coronavirus is going to just send shockwaves through the economy, and not just ours. It's going to send it through the global economy, and it's going to be all lagging. We're not going to know the effects of this until 3, 6, 9, 12 months down the road. We're not going to know. It's going to take time for things to resettle, for everything to kind of recalibrate dealing with this virus. And you have 105, this is the CDC, 105,586 confirmed cases. You go here, we got 109. So, we have over 100,000 confirmed cases. We have travel bans, we have school closings, we have shipping being held up. It's going to impact the economy. If it is only as bad as the flu, the fear that the news and media is creating is going to cause economic shock. And you need to understand that, because if you're dealing with a portfolio, and let me just see if you're looking at your portfolio right now and you've taken a hit, there's no way you're going to be able to judge if your portfolio is going to take more of a hit or less of a hit in the future, right? You can't assume that this shock was December of 2018 and we're just going to go up for a year. You can't assume that. You have to position yourself defensively at this point. So here's the problem with positioning yourself defensively in this environment. It's going to be extremely hard to do. So I was preaching value, right? Energy, materials. I said, hey, you could get this stuff at great prices right now. You want to know what the problem is? Is that these sectors are heavily dependent on the economy. And if the economy is going to get hit, then you can assume that you're going to see lower prices in these sectors. But let's say you were just going to go to utilities. Well, hey, how about I hang out in utilities a little bit more and go grab some yield? We may not have seen parabolic yet in utilities. It looks parabolic, but we may not have seen parabolic. So could we get up to a new all-time high in utilities? We could. Same thing with REITs, with the real estate sector. We could yet to see a new high. But if everybody's hiding out in bonds and everybody's hiding out in utilities and REITs, what are you going to do when things turn around? So I always like in this situation to shave profits, grab yourself some cash, and then sit and wait. Patience is a luxury. If you have any kind of patience right now, that is an absolute luxury in this market. You cannot assume that we are not going to take out that low, right? February 2018, we came down, came up, boom, tested that low. We didn't take it out, but we tested it. Later that year, we absolutely took out that low. If you look at other corrections, again, sorry there. If you look at the shocks here, right? Came down, recovered, almost took it out, and then boom. I believe that did take it out just a little bit. So you can't assume we're not taking out this low. And the best case scenario is, hey, we just go all the way down to 2,700 and then that's it. And then everybody can just put their buying caps back on. What's likely going to happen is this market is going to make you wiggle for a long time. Maybe a year, maybe 2 years. But this was a major shock, and you have to be prepared for it. And I think cash is a great position to be while this is playing out. And look, you could recover from here. And this is what always happens. Come back up. Oh, we're in the clear. Everything's fine. And then all of a sudden, you come back down, you take out that low. The second you feel good, like we're probably going to rally this week. I wouldn't be surprised. I think the oil market is going to get murdered, literally and figuratively. But even in that scenario, I don't think we see this low again this week. We may, but just be prepared for that feeling like coast is clear. Because the second you feel like the coast is clear, that's when we're going to be coming back down and testing that low. So, kind of the themes of the video is this isn't like 2018. Cash is a position. Be prepared when the time comes to allocate that cash to the most inexpensive, undervalued sectors that there are, which is energy, which is industrials, which is materials. I know I've been saying that since the beginning, but if you're positioning yourself for a 5-10 year time horizon, you have to forego the I want to see green now. You have to forego that feeling. Because if you're searching for green, then go ahead, buy yourself some Amazon, put all your money in Amazon, and then close your eyes. Because this thing's probably going to rally. But this is also in a bad, right? Okay? We've been going straight up. Straight up. And yes, Amazon's probably going to take over the world at some point. But even here, even after a 600% rally in 3 or 4 years, actually that's probably in 4 or 5 years, this can consolidate and this could correct just like anything else can. So you can't assume that the leaders in this market are going to continue to lead. So the warm and fuzzy feeling that the names you know give you, you need to stop thinking that they're going to always be warm and fuzzy. Just look at Under Armour. Under Armour is a great example of this. People know the name, you start seeing Under Armour ads, everything is great, goes up 350%. Oh my God, everything's great. You cannot assume that this cannot happen to your favorite stock. Okay? So whenever you see something parabolic, you cannot assume it's not going to get cut down by 75% like it did to Under Armour. Lulu. If you think Lulu isn't going to do the exact same thing Under Armour is going to do, Under Armour has already done, I can't help you. Because this thing is coming back down all the way probably to $80 a share. So that would be 70 something percent. It's going to happen. It's only a matter of time. So no, it's not going to be fun to hang out in materials, energy, and industrials, but in the long term, it's the better bet at this point. Especially because I don't think any of these retail plays pay a dividend. So why would you ever want to buy Lulu at $200+ a share when you could wait a couple years and you could probably get it under 100? Okay. All right. I'm going to do it's not going to be a third part market update, but I need to get all these things across. So the next video I'm going to do is exclusively portfolio building. So stay tuned for that. I'm going to try to create a few Morningstar reports so you can really get a good idea of, how your portfolio can perform, some of the ways to kind of blend the sectors, blend the small, mid, and large cap stocks, blend risk, all that kind of stuff. So stay tuned for that, and everybody have a good one.